Robschild. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Today is Monday, September 9th, 2024. Today's episode, I want to start by taking a look at SPY, bearish RSI Divergence. A viewer commented recently discussing some signs of weakness in the S&P 500, and it got me to think, like, I haven't checked the RSI for a while. What's going on here? And oh boy, did I find something. This is the weekly time frame of the S&P 500, and I want to point out that very notably, when we had a high back in July of the S&P 500, we had 2 weeks ago, recently, a closing high that was higher than this previous peak, and yet on the RSI, clearly a very, very much lower high in the RSI. This is not like a small divergence here. This is a very big divergence. Also, when we take a look at the lows, when we had the yen carry trade blow up, we had RSI hitting a low here, and on last week's candle, we actually had a lower high set in on the RSI. This adds a lot of weight to the bearishness of the market right now. The next subject I wanted to bring up today in today's episode is credit spreads and how I'm playing it, how I'm kind of seeing the whole thing. Here is a chart from Fed, St. Louis Fed, of basically the spread between high-yield corporate bonds, in other words, bonds that are below investment rating. How much more expensive is it for companies that are below investment grade bonds to be paying for borrowing money? As you can see, when the market's seeing a little bit more risk with higher risk businesses, it goes up. So higher means that investors are like, we're going to need to get more money for our money compared to what we can get from the treasury rate. And then when times are good and people don't see any risk at all, the credit spreads get tight. So the difference between this set of bonds here, which is double B and lower, and treasury bonds, sometimes the difference is only 2.5%, and sometimes it can be as high as 10%. Or in the financial crisis, it was briefly 20% difference. So I've been talking about, I'll scroll in here in the bottom so we can get a closer view. I've been talking about how credit spreads have been getting lower and lower as more and more evidence has been coming in that the economy is actually getting weaker here, which is just continuously surprising me how thin credit spreads are. Because of this, I'm thinking that it could be advantageous to bet on this spread widening, especially in the near future, for 1,000 reasons. The way I'm doing this is simply buying some puts on HYG. There's very surprisingly low volatility priced in right now with these options contracts. You can get them dirt cheap, and if we do have like a major market correction, which is what I'm expecting, I see the market falling. I think it's going to keep falling. And as it does, credit spreads should widen, and if credit spreads do widen, the value of junk bonds drops, which would mean, puts on that. It's a cheap, easy hedge to be able to take advantage of credit spreads widening. And not only that, so it has a two parts to it that can be advantageous to being on the short side of junk bonds right now. So on one side, all you need is credit spreads to widen, and the value of HYG will drop, and puts can print, right? But the other way is that, let's say all of a sudden the CPI coming out this week is like hotter than normal, and like the economy is fine. Let's say the next jobs report is great, everything is just like humming along, and people realize, inflation's coming back. Well, what happens then? Well, then rates go up. What happens when rates go up? The value of HYG drops anyway, besides the credit spreads. You know, one of the reasons HYG, HYT, these high yield corporate bonds have been going up in prices simply because the guaranteed yields are dropping. People are paying more for all across the different credit rated bonds. And so if I'm wrong, then I'm right anyway, because, you know, if things are heating up and yields need to go up, then the value of junk bonds also will be dropping in value here. I feel like I'm playing the market here, a game like heads I win, tails you lose kind of situation. It feels good to be in this position. But as always remember, nothing you hear on this show is investment advice, and I'm just a guy with a crystal ball. If you don't know who Lynn Allen is, you should probably turn this video off and watch her talk. She's made a lot of incredible calls that nobody else has made in the past. Will that continue? It is to be seen. She just had her September article released, and it's very good. It's very worth looking at. You know, as much as I believe that we're headed into disinflation, deflation type of recession or depression, she has reason. She has her own strong and good reasons to believe that, you know, we might, in this cycle, we might end up having higher lows, like she says. And like I've referenced in other shows, in interest rates. So how we've gotten to kind of all-time low, where interest rates have spiked up, and then we get to a higher low. And then, you know, the trajectory beyond there, it's really anyone's guess. But definitely check out her website, sign up for her free newsletter. Her September newsletter just came out. This is the one, Why Nothing Stops This Fiscal Train. Again, her main point is that she doesn't see the government slowing down spending at all, and she doesn't know where the money is going to come from. And, you know, she sort of sees more of I think, a stagflationary environment coming than anything else. And she also sees that, you know, gold is like really high, the S&P is really high. You know, bonds, she says in the article, are like a sardine for trading. So she might even agree that long bonds may be good temporarily, but she says in there not for a 5-year time horizon. Anyway, check her out. She's worth knowing about and reading her stuff. Obligatory daily reminders. 2-year, 10-year Treasury yield curve was inverted for over 2 years. This has not happened since before the Great Depression. And some people argue that that may have been a big part of what made the Great Depression happen. It's now uninverted. This is typically the part of the cycle where the market is like, well, like I say in my crystal ball reading, this is typically when things fall apart and we have market crashes and that kind of a thing. Also, other daily reminders, Sommerl was triggered, saying that the recession has started. Unemployment has risen at an unsustainable pace, suggesting that it's going to continue in that direction. And my crystal ball reading, again, yeah, I believe the market crash continues for 1,000,001 reasons. And I also believe that the Fed will not cut fast enough to save the economy. I'm kind of tired of hearing people somehow believe that doing one rate cut is suddenly gonna like light the market back on fire and inflation is gonna go back up to 7% just like that in a second. It's not how it works. The cuts, the whole economy reacts to cuts like very, very slowly. The evidence of the first cut we may not see for like a whole year. It's a very slow moving ship. So that's just where we are in the cycle. On to the charts. This is SPX, the S&P 500 daily bar chart. Notably, on Friday, we had that very large red candle day, which I saw clearly in my crystal ball. I predicted it. I thought it was actually going to be more bearish. The unemployment report came out less bad than I thought it was going to be, so it wasn't as big of a red candle as I thought it was going to be. Now today's movement, this is what I would call an inside candle, just, you know, basic chart reading, right? It's inside of this, you know, bear trend and bearish candle, suggesting that still it looks like more weakness is ahead. There's slightly less probability of it. You know, ideally, when you have a big red candle, you want to see a flag at the bottom of this, starting from the bottom. Instead, we're right at the middle, but it's still a bearish day. And the probabilities are more that it's going to keep going down here than anything else. Obviously, the same exact thing in the triple Qs in the NASDAQ. Again, this head and shoulders longer term top is still very, very strongly in play. I see clearly that this is going to play out. We'll see if it does. The VIX cooled off a little bit today, but not a whole lot. We're still highly elevated. The way that I look at it, markets are definitely still on fire here. Kind of just waiting for the next thing to blow up, the way I look at it. VIX futures term structure. It's amazing how wild this thing looks lately. You know, in normal conditions, you start low and it just gradually goes up. This is crazy. There's so much volatility priced into October. You know, the front end of the curve, it obviously dropped today relative to the rest of the curve, but we still have October expecting a lot more volatility coming. TLT, what a good place to be. We have a close that I believe is, yeah, this is a new closing high of recent time. We haven't seen it this high since really looks like December of 2023. So bonds are still strong. So we won the battle, by the way, for anyone that's a bond bull with me. As if you've been following the show, you know I'm about 55, well now it'll be more like 57% or something like that, exposed to long bonds. My favorite funds are ZROZ and TMF, leveraged versions. I have longer dated calls on them too. This is TLT. This is the standard one for long bonds. I said yesterday how there was such a crazy fight going on. You can barely see this candle with a wick going way up and down and opening and closing exactly at the same point. The bears clearly just took over and just charged upward today. This is looking very bullish for bonds. Last thing really is just junk bonds. I like to use HYT, HYG, also PFF, preferred shares, index ETF. So yeah, all-time closing high in junk bonds as well. You know, obviously this has a lot to do with the fact that, again, when the guaranteed rates are lowering and going lower, then the yields on junk bonds can also go lower, propping up the prices. And so they're moving in sync with each other right now, suggesting still that there's obviously no fear of these junk bonds. I personally have tons of fear over junk bonds. I would not even consider thinking about buying junk bonds right now. Looking at all the opportunities out there, where we are in the cycle, what's going on here, I think you'd have to be crazy to have it. And the volatility being so incredibly low is making put contracts on these things incredibly cheap, in my opinion. And so we'll see how this plays out moving forward. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching and see you next time. Rob's Child.